Welcome to the deep dive. I want you to picture this for a second.
Okay, let's hear it.
The American consumer is just completely tapped out. We are looking at a wild macroeconomic roller coaster. I mean, gas prices spiked all the way to $4.61 a gallon back in May.
Yeah, that was brutal.
Right. And the core customers walking into convenience stores are hurting so badly that a minor, and I mean minor, bureaucratic change in food stamp eligibility in just a few states is actually cratering national revenue.
It really shows you how thin the margins are for the average household.
Exactly. People are so financially exhausted, they are buying gas $10 at a time. They are completely terrified of a full tank.
Just surviving day to day.
Yeah, it is an economic hurricane out there.
Yeah.
So with all that context, why did one of the country's largest convenience store chains just drop $205 million in cold, hard cash to buy millions of gallons of more fuel capacity?
The contrast is jarring, honestly. You have this retail environment that is just bleeding physical volume on one side.
Right.
And then you have a corporate entity acting like a distressed asset raider, buying up massive infrastructure on the other. On the surface, it looks like a company buying a fleet of cruise ships while staring down a Category 5 storm.
Yeah, it really does.
But if you look closely at Arko Corp's second quarter earnings call for 2026, it reveals a very deliberate, almost ruthless chess game. We are watching a total masterclass in how a business attempts to squeeze margin out of a shrinking volume environment.
Okay, let's unpack this. We are looking at Arko today, ticker symbol ARAKO.
Yep. And
to understand how they are surviving this consumer drought, we have to look at the scoreboard first. The raw data for the second quarter gives us a bizarre mix of, the good, the bad, and the highly complicated.
Which is pretty typical for them lately.
Very true. So here is our blueprint for this deep dive. First, we are hitting the headline numbers, the raw data. Second, the story behind those numbers. What's actually happening at the street level?
The fun stuff.
Exactly. Third, we'll look at management guidance, basically what the C-suite is predicting. And finally, the bottom line, the actionable bull versus bear case for your portfolio.
Sounds like a solid plan. Let's start with those headline numbers.
Right. So the core number Wall Street obsesses over, which is adjusted EBITDA, came in at $72 million for Q2.
Okay.
Now that is down from $76.9 million in the same quarter last year.
Which, is a surface level miss. And that often triggers panic selling from algorithmic traders who just scan the headlines.
Oh, absolutely.
But if you zoom out to the first half of the year as a whole, it tells a completely different story. Year to date, their adjusted EBITDA is actually up 14%.
Wow, wait, up 14%?
Yeah, to $122.9 million. The trajectory is strong because they had a massive 65% jump in the first quarter.
Oh, right, driven by some very aggressive fuel pricing strategies early in the year.
Yeah.
That context is totally crucial because, the net income number looks even scarier if you just read a headline.
Oh, yeah, it does.
For the quarter, net income was $9.4 million, but last year it was $20.1 million.
So it looks like it got cut in half.
Yeah, exactly. An investor glancing at Yahoo Finance sees a 50% haircut and assumes the core business is just collapsing. But my understanding of this drop is that it's essentially an optical illusion tied to a real estate maneuver from the previous year.
That is exactly what it is.
Because last year, they recorded a $20.8 million non-cash gain from a sale-leaseback transaction, right?
That is the culprit right there. We have to separate the actual business of selling snacks and gas from, financial engineering.
Right.
A sale-leaseback is a classic private equity maneuver. Basically, Arko takes the physical dirt and the building of a gas station they own, they sell it to a real estate investment trust for a huge lump sum.
And then immediately sign a long lease, right?
Yep, a 20-year lease to keep operating on that exact same spot.
So they're unlocking the frozen capital trapped in the real estate. It gives them this massive one-time paper gain on the balance sheet for that specific quarter.
And it completely skews the year-over-year comparison. I mean, that $20.8 million gain had absolutely nothing to do with how many hot dogs they sold or how much foot traffic they drove.
Right, it's just accounting noise.
Exactly. If you strip out that one-time accounting noise from last year, the core operations of the actual business look fundamentally stable. The underlying engine didn't stall, they just didn't sell any buildings this quarter.
Okay, that makes sense.
Emmy.
Which brings us to the most baffling part of the data dump, something I'm calling the margin miracle.
Oh, I like that term.
Thanks. Let's look at the actual physical sales volume. Same-store merchandise sales, which is the stuff inside the convenience store minus cigarettes, dropped by 0.9%.
Okay.
And fuel volume. The actual physical gallons of gas pumped by consumers dropped by 5.7%. Foot traffic is down, demand is down.
Yeah, the physical throughput of the business is undeniably shrinking. There's no hiding that.
Yet, despite selling fewer snacks and moving millions of fewer gallons of gas, their merchandise profit margin expanded by 110 basis points to 34.7%.
That's a huge jump.
And their retail fuel margin jumped 6.5%. That allowed them to pull 48.7 cents of pure profit out of every single gallon.
Which is honestly incredible execution.
I mean, they sold less stuff, but they extracted more profit per item. It feels like a movie theater operating with a half-empty room, but they've jacked up the price of popcorn and soda so high that they're actually making more money on the screening.
That's a great analogy.
But I just have to wonder, how sustainable is that kind of friction with the consumer?
Well, the sustainability question is really the central tension of this entire company right now. To understand how they achieve this, we need to dive into the mechanics of what management calls disciplined pricing.
Disciplined pricing?
Yeah. So when commodity gas prices spiked up to $4.61 in May, Arko faced a critical operational choice. Historically, when a gas station operator sees volume dropping, panic sets in.
Naturally.
Right. So the instinct is to slash retail prices, basically compressing the profit margin to almost zero just to get cars pulling onto the lot.
It's a race to the bottom. You give away the gas at cost, the customer walks inside and buys a high-margin energy drink.
Exactly. But Arko actively refused to play that game. They recognized that elevated commodity prices were a macroeconomic wave they just couldn't control.
So what did they do?
Well, rather than slashing prices to chase a shrinking pool of drivers, they held their ground. They protected their profit margins per gallon.
Even if it meant losing customers.
Yes, the CEO essentially admitted they knew they would lose some physical volume, but they minimized the financial damage through strict execution at the pricing desk. Yeah, by pulling nearly 49 cents of profit out of every gallon, that massive margin expansion entirely masked the 5.7% volume decline on the final balance sheet.
But protecting that margin at the pump comes with hidden structural traps, doesn't it?
Oh, absolutely.
Because there is a fascinating, almost invisible cost buried in this earnings call. It's a $3.3 million increase in credit card swipe fees on a same-store basis.
Yeah, that's a painful one.
That is $3 million of pure profit just vaporized by Visa and MasterCard. And it happens entirely because of how merchant interchange fees are structured against commodity prices.
It perfectly illustrates how macro inflation silently taxes the retailer because, those swipe fees aren't flat rates.
Right. The credit card company doesn't just charge a flat 10 cents every time you dip your chip. They charge a percentage of the total transaction value. Right. Let's walk through the math on this because it's brutal for the merchant. Let's say Arko has locked in their 38 cents of profit per gallon. When gas is cheap, say $2 a gallon, a 20-gallon fill-up costs the consumer $40.
Okay, following you.
The credit card company takes their 2 or 3% cut out of that $40.
But when global oil markets panic and gas spikes to $4.61, that exact same 20-gallon fill-up now costs over $90.
Right. And Arko is still only making their fixed 48 cents of profit on each of those gallons. Their gross profit on the fill-up hasn't changed at all.
But Visa and MasterCard are now taking their percentage out of a $90 transaction instead of a $40 transaction.
Yeah, the credit card networks essentially give themselves a massive raise just because the global price of crude oil went up. And every extra penny they take comes directly out of Arko's bottom line.
It's wild. The station is doing the exact same amount of work, making the exact same margin, but they're losing ground to the payment processors.
It really highlights a severe vulnerability in the traditional convenience store business model.
It does. Commodity inflation at the pump hurts the retailer twice over. It suppresses consumer demand, which causes the volume drop we discussed, and simultaneously inflates their operational transaction costs. It is a squeeze play where the retailer absorbs all the friction.
So we see the margin expansion masking the volume decline on the corporate spreadsheet. But what is actually happening when that stressed consumer walks through the door?
That's the real story behind the numbers.
Right. Let's look at the street level reality. I found a highly specific data point in this transcript regarding SNP, what most of us know as food stamps.
Oh, this was a fascinating detail.
Yeah, the CFO noted that lowered SNAP EBT spending in the second quarter reduced their same-store sales growth by roughly 75 basis points.
Almost a full percent.
Nearly a full percent drag on a national chain's revenue, driven almost entirely by tightened eligibility rules in just 3 states.
That is a staggering metric when you consider the scale of Arko's operations.
Right.
SNAP EBT purchases account for less than 2% of their total sales.
Right. It's a tiny slice.
It is exactly, gas tank anxiety. The whole filler-up mentality is dead for the working class consumer.
It is entirely dead. Consumers simply cannot afford to authorize a $75 hold on their debit card to top off an SUV.
No way. The behavioral shift is all about micro-purchasing out of pure necessity. The consumer is pulling in on a Tuesday, putting exactly $10 on pump 4 just to get enough fuel to commute to work, and then returning on Thursday to put in another $10 to make it to payday.
That's so bleak. They are spending the exact same amount of time at the station, creating the exact same amount of wear and tear on the infrastructure, but buying significantly less product.
Yes. So the question becomes, if your core customer is this tapped out, and your volume is steadily bleeding, how does a company fight back without just relying on high gas prices?
Right. And that brings us to their counteroffensive, which is heavily focused on loyalty data and food.
2 things they are pushing hard.
Now, I'm usually pretty cynical about gas station punch cards. We've all been asked to put our phone number in at the pump to save 3 cents a gallon, and it always feels like a data harvesting gimmick that offers negligible value.
Yeah. Usually it's just annoying.
But the behavioral data Arko is pulling from their Fueling America's Future program is genuinely interesting.
They have basically weaponized the loyalty program by actually offering meaningful economic relief to that stressed consumer we just talked about.
They really are. They are offering stackable discounts up to $2.50 per gallon on up to 20 gallons.
That is $50 of potential savings on a single fill-up.
Yeah, and the data proves it is heavily altering consumer habits. Enrolled loyalty members are spending more than twice as much monthly as non-enrolled members.
Wow, double.
Yep. Their visit frequency and their basket size, which is the amount of high-margin items they buy inside the store, are both 50% higher.
See, the mechanism here isn't just about giving away margin to be consumer-friendly. It is a highly calculated strategy to control the flow of traffic.
How so?
Take their 10-cent Tuesdays promotion.
Right.
The CEO highlighted that since launching this specific initiative, enrolled gallon sales on Tuesdays have experienced double-digit growth. They have effectively doubled their enrolled volume on a highly specific day of the week.
Okay, but my initial thought is, why does management care if I buy my gas on a Tuesday versus a Friday, as long as I buy it?
Because of labor optimization and supply chain predictability.
Okay.
Tuesday is traditionally a total dead zone in retail. By manufacturing an immense spike in traffic on a historically slow day, management can optimize their staffing schedules with real precision.
That makes a lot of sense.
They know exactly when to dispatch their fuel tanker deliveries, minimizing logistical downtime. They basically smooth out the unpredictable volatility of a standard retail week.
Right.
But more importantly, they guarantee a predictable surge of foot traffic that they can then attempt to monetize inside the store.
And monetizing inside the store brings us to the food factor, specifically their Fies Craves brand.
Yes, this is huge for them.
During the call, management was heavily pushing a combo deal, a chicken sandwich, Coca-Cola, and potato wedges for $5.
$5.
$5. You can barely buy a drip coffee for $5 in most major cities. It almost sounds like a loss leader.
Well, it acts like a loss leader from a marketing perspective, but mechanically, it is the primary driver of that 110 basis point merchandise margin expansion we dissected earlier.
Wait, really? How does selling cheap food increase their overall margin?
To understand convenience store economics, you have to look at the transition from packaged goods to prepared foods. When a store sells a bag of branded potato chips or a candy bar, the manufacturer has already extracted most of the profit margin.
Oh, right. Frito-Lay makes the money, not the gas station.
Exactly. The convenience store only captures a small slice for putting it on the shelf.
But with prepared food, you control the raw ingredients.
Precisely. You're taking raw chicken, potatoes, and fountain syrup that cost pennies on the dollar and selling them for $5. The gross margin on fountain drinks and hot food is exponentially higher than anything in the packaged snack aisle.
That is brilliant. By heavily discounting the fuel at the pump to capture the consumer's attention and then offering a highly perceived value meal inside, they are actively transitioning their product mix.
They really want to be viewed less as a gas station and more as a quick service restaurant.
They are putting serious capital behind this transition, too. They completed 2 full store remodels this quarter. They have 12 more in progress, and they are targeting 25 remodels in 2026.
It's a real investment.
And the CEO pointed out that these remodeled locations, which emphasize this high-margin food layout, are seeing double-digit sales and gallon growth compared to their pre-remodel baseline. The capital expenditure is clearly paying off.
It is validating the strategy on a micro level, for sure. However, there is a much larger structural shift happening in the background.
Okay, what's that?
Well, while the chicken sandwiches make for great marketing copy, the most important transformation for the company's long-term risk profile is their real estate and operations strategy.
Let's get into the Wall Street jargon then, because the transcript heavily features the word dealerization.
They love that word.
Management loves talking about their dealerization pipeline. Let's translate this for the listener. My understanding is that dealerization is basically turning a corporate-owned store into a franchise.
In the simplest terms, yes. It is the process of converting a company-operated retail site into an independent dealer-operated site.
Okay.
But the financial mechanics behind why a company does this are crucial to understand. Historically, under a company-operated model, Arko owned the dirt, owned the building, hired the cashiers, paid the monthly utility bills, managed the local inventory, and absorbed all the day-to-day operational friction of running a retail business.
That is a massive amount of operational risk. I mean, if a blizzard hits and nobody buys gas for 3 days, Arko still has to pay the cashier to stand there. If the local municipality raises the minimum wage by $2 an hour, Arko's margin instantly compresses.
Precisely. It is highly variable, highly vulnerable revenue. But under the dealerization model, Arko essentially hands over the keys to an independent operator, the dealer.
Okay, so the dealie takes the risk.
Yes. This dealer takes on the absolute responsibility of hiring local staff, managing the payroll, dealing with inventory shrink, and keeping the lights on. The operational headaches are entirely transferred.
So what does Arko get in return if they aren't collecting the daily cash register receipts?
Arko secures a long-term, ironclad contract to be the exclusive wholesale supplier of fuel to that location.
Oh, wow.
Furthermore, they collect steady rent on the real estate they own, and they take a recurring royalty or franchise fee.
So they are turning themselves into a landlord and a toll booth operator.
Yeah.
The numbers in the transcript show exactly how powerful this is. Their site-level operating expenses dropped from $176.6 million down to $160 million.
That's a huge drop.
They permanently erased over $16 million in operating expenses simply by making these stores someone else's daily problem to manage.
It's such a smart move.
They converted 21 stores this quarter alone, bringing the total to 471 conversions since mid-2024. They only have about 70 left in the pipeline.
The structural implications for the investor are monumental here. By executing this dealerization program, Arko is fundamentally altering its corporate identity.
Right.
They are taking retail revenue, which fluctuates wildly based on consumer sentiment, local weather events, and labor markets, and converting it into a steady, predictable, recurring fee stream.
It requires significantly less maintenance capital, too.
Yes, and it protects their baseline cash flow even when the macro consumer environment is in total turmoil.
That structural shift makes perfect sense. But now we arrive at the $205 million elephant in the room.
There we go.
The U.S. Petroleum Partners acquisition. Let's lay out the facts. Arko operates a publicly traded subsidiary called APC, which basically functions as their wholesale arm.
Right.
APC just signed an agreement to buy U.S. Petroleum Partners, or USPP. The price tag is staggering. $205 million in hard cash, plus the cost of existing inventory, plus another $30 million in stock as an earnout if USPP hits specific earnings targets.
It is a massive allocation of capital that represents a major bet on the future of physical logistics.
And this is where I really have to push back on management's logic.
Okay, let's hear it.
We just spent the first half of this deep dive detailing how the American consumer is financially broken.
Very broken.
Gallons sold at the pump are dropping by nearly 6%. 5%. Drivers have gas tank anxiety. The physical throughput of the industry is shrinking.
Right.
So why on earth is Arko management taking over $200 million in cash to go out and buy 280 million more gallons of fuel capacity?
It is the defining paradox of the earnings call. And it is exactly the kind of critical thinking you as an investor need to apply.
So what's the rationale?
To understand the logic, we have to completely separate the retail convenience store business from the wholesale logistics business. This acquisition isn't about selling more gas to the retail consumer.
It's not.
No, it is a pure play on massive economies of scale and supply chain leverage.
Okay, let's break down the plumbing of that supply chain.
Arko currently sells roughly 2 billion gallons of fuel a year across their entire network. By acquiring USPP, they're absorbing an additional 280 million gallons into their annual volume.
Okay, so getting bigger.
Right, and that represents an immediate 14% increase in their absolute buying power. When Arko's procurement team sits down at the negotiating table with major oil companies like Exxon or BP to hash out their wholesale fuel contracts, the only leverage they have is volume.
So by bringing an extra 280 million gallons to the table, they can demand a lower cost per gallon for their entire 2 billion gallon network.
Exactly. In the wholesale fuel business, we are talking about fractions of a penny. But if that 14% increase in volume allows Arko to negotiate even a 1/10 of a cent improvement in their wholesale costs, you multiply that 1/10 of a cent by 2 billion gallons, and millions of dollars of pure profit immediately drop to the bottom line, requiring zero additional effort from the retail stores.
Wow, just purely from negotiating power.
Yes. But the scale of purchasing is only half the story. The real strategic prize in the USPP acquisition is the physical infrastructure.
You are talking about the pipeline terminals, because
Right.
the transcript mentioned 2 fuel terminals on the Buckeye pipeline.
Yes. And to understand why this matters, you have to look at how fuel actually moves. Historically, Arko has functioned primarily as a retailer. The fuel is refined, it moves through a pipeline owned by someone else.
Right.
It sits in a massive storage terminal owned by someone else, and then Arko buys it at the terminal rack and pays a trucking company to deliver it to their gas station. Every single hand that touches that fuel takes a margin.
But USPP owns the actual terminals on the Buckeye pipeline, along with a massive transportation fleet.
Which means Arko is vertically integrating their supply chain. They are eliminating the middlemen.
So they capture all those margins.
Yep. They are no longer just capturing the 48 cents of retail margin at the pump. They are now capturing the storage margin at the terminal, the transportation margin on the highway, and the wholesale distribution margin.
Ah, I see the play. And management noted that USPT currently has more than 50% available unused terminal capacity. So Arko can immediately start routing their existing fuel purchases through their newly acquired terminals, absorbing the storage fees they used to pay to third parties. It is a brilliant efficiency play.
It really is.
But being a wholesale distributor isn't always a guaranteed money printer, which brings up a fascinating headwind mentioned in the call: the fleet fueling squeeze.
This is a vital counterweight to the excitement surrounding the acquisition. It really exposes the inherent unpreventable risks in the wholesale contract model.
Right, because Arko operates a massive commercial fleet fueling business. These are essentially unstaffed, card-only gas stations designed for long-haul commercial trucking fleets known as cardlocks.
Correct.
Now, commercial trucking is generally considered a highly stable, recurring business, but the transcript noted that operating income for this entire segment was completely flat year over year, stalling out at roughly $13 million.
While their retail margins were exploding, their commercial margins compressed.
Exactly. The CFO blamed the stall on something called OPIS plus pricing. My understanding of index pricing is that it usually protects the seller. You just pass the wholesale cost along to the fleet driver plus a fixed markup. But it sounds like they got caught in a timing trap here.
You've hit the nail on the head. It is entirely a timing trap. OPI stands for the Oil Price Information Service. It is the industry standard index that tracks the daily wholesale price of fuel.
Okay.
In the commercial fleet business, Arko secures these massive long-term contracts with trucking companies using an OPIS plus model. They agree to sell the fuel to the trucker at whatever the OPIS index price is on that specific day, plus a guaranteed fixed margin, let's say 3 cents a gallon.
Which sounds completely foolproof. I mean, you are contractually guaranteed a 3-cent profit on every gallon pumped, no matter what the global oil market does.
It is foolproof in a stable or steadily rising market. but it creates a brutal mechanical lag effect during periods of rapidly falling commodity prices.
How does that work?
Think of it like a grocery store buying a massive shipment of avocados at peak premium prices. They put the avocados in the back room.
Okay.
Then the next morning, the global market price for avocados completely crashes.
So the grocery store is stuck holding expensive inventory, but customers expect to pay the newly crashed market price.
Exactly. When the wholesale price of gas crashes quickly, the OPIS index drops immediately. Because of the contract, the price Arko charges the trucking company drops immediately.
But their inventory.
Right. The physical fuel sitting in the underground tanks at Arko's cardlock stations was purchased and delivered a week ago when prices were near their peak. They are contractually forced to sell premium-priced inventory at today's discount bin index prices.
Ouch.
That timing mismatch completely compresses or even temporarily eliminates their fixed margin. It is a structural hazard of the commercial fueling business that they simply have to absorb during periods of extreme downside volatility.
That perfectly illustrates why supply chain logistics isn't just a matter of buying infrastructure and printing money. There is serious risk management involved.
Absolutely.
So if they have this massive new wholesale engine coming online with the USPP acquisition, and they've successfully shifted their retail operational risk to franchisees through dealerization, their end-of-year profit projections must be sky high, right?
You would think so.
Well, that's where this earnings call takes a very cautious, almost paranoid turn into management guidance.
The forward-looking data here is incredibly telling, not for what management changed, but for what they steadfastly refused to change.
Let's look at the guidance. Management reaffirmed their full-year adjusted EBITDA guidance of $245 million to $265 million. They did not move the goalposts 1 inch.
Nope.
They did marginally increase their retail fuel margin outlook to 45.5 up to 47.5 cents per gallon, explicitly stating this was necessary to mathematically offset the lower physical volumes they expect to see.
Right.
But here is where the logic seems to disconnect. And again, I have to push back on the C-suite.
Where's the disconnect for you?
Look at the timeline of the year. In the first half, their EBITDA was up 13% year over year.
Sure.
They just announced a $205 million acquisition of USPP, and the CEO explicitly stated on the call that this acquisition is expected to add $30 million in annual EBITDA and will close later this year.
Also true.
So they have a massive financial head start on the first 2 quarters, and they are bringing a brand new $30 million profit engine online before New Year's Eve. Yet they flat out refuse to raise their full year guidance. What is management so terrified of in the back half of the year that they won't adjust their numbers?
This is where you really have to read the tone of the room, specifically listening to CFO Gallagher Jeff. When institutional analysts pressed him on this exact contradiction, why not raise guidance given the strong first half and the massive acquisition? He explicitly cited uncertainty and consumer volatility. Yeah. He noted that consumer behavior in this current macro environment seems to change month to month, defying traditional forecasting models.
So are they just sandbagging, lowering expectations so they can easily beat them in Q4 and look like heroes to Wall Street?
I wouldn't classify it as sandbagging. I would call it fortifying against a storm they can clearly see on the radar.
Fortifying.
Yeah. Management is heavily padding their estimates because they genuinely do not know if the softening retail demand they witnessed in June was just a temporary seasonal blip, or if it's the leading edge of a severe, protracted consumer recession.
That's a scary thought.
If a CFO raises guidance now based on a strong Q1, and then the bottom completely falls out of the consumer economy in October, Wall Street will punish the stock relentlessly.
Oh, they'd get crushed.
Exactly. By holding guidance flat despite the positive catalysts, they are giving themselves a massive margin of error to absorb future economic shocks.
That extreme caution is mirrored perfectly in how they are allocating their capital right now. They are sitting on a massive war chest, roughly $1 billion in total liquidity.
It's a very strong position.
But look at how they are playing financial chess with that cash. They took $35 million in hard cash and used it to buy back $38 million worth of their own 5.18% senior notes at a discount.
This maneuver highlights a fundamental principle of corporate finance in a high interest rate environment, and it's honestly a brilliant use of capital.
Let's explain the bond math on this because it's a great lesson for retail investors.
Go for it.
When Arko issued those bonds years ago, interest rates were low, so they only had to pay 5.18% interest. But now the Federal Reserve has raised rates significantly. New bonds are paying much higher yields.
Right.
So nobody on the open market wants to buy an old Arko bond paying 5% when they can get a risk-free treasury paying 5%. Because the old bond is less attractive, its trading value drops below its original face value.
Exactly. The bond trades at a steep discount. So Arko steps into the open market and buys back their own debt for pennies on the dollar.
Right. They spend $35 million in cash to permanently erase $38 million of debt obligations.
It is an instant guaranteed return on their capital. It permanently reduces their outstanding principal, it lowers their future quarterly interest payments, and it fundamentally cleans up the leverage on their balance sheet.
And what is truly wild is the sequence of events. Simultaneously, right after the second quarter officially ended, they went to PNC Bank and successfully increased their credit lines by an additional $74 million.
So smart.
Right. So in the same breath, they are paying down rigid long-term bond debt while actively expanding their flexible short-term borrowing capacity.
That dual maneuver is the textbook definition of fortressing the balance sheet. They are retiring fixed, unyielding debt obligations and replacing them with highly flexible, available liquidity.
Just building a moat.
Yeah, the CEO noted their internal mandate is to keep their net debt to EBITDA ratio between a healthy 3 times to 3.5 times. By maintaining that strict financial discipline, they ensure that no matter how bad the retail environment gets, no matter how much the consumer pulls back, the corporate entity is never at risk of a liquidity crisis.
They're ready for anything.
They have the dry powder to survive the storm, and more importantly, they have the capital ready to acquire weaker, over-leveraged competitors who didn't prepare their balance sheets.
Which brings us to the final piece of our analysis, the bottom line.
Let's do it.
We've translated the corporate jargon, we've analyzed the raw data, and we've peered into the risk-averse minds of management. Now, what does this actually mean for you, the retail investor looking at RRKO stock? It's time to build the bull and the bear case.
I will actually take the bear case first, because there is plenty of red meat in this transcript for the skeptics.
The floor is yours. Lay out the macro risks.
The bear case for Arko is entirely macroeconomic, and it centers on the undeniable fact that their core customer is bleeding out. True. When a slight bureaucratic change to food stamp eligibility in just 3 states tanks your national same-store sales by nearly 1%, your customer base is incredibly fragile. Gas prices are actively forcing working-class drivers to abandon the fill-up and buy gas $10 at a time. You can't squeeze blood from a stone.
The physical throughput is shrinking. You can't deny it.
Yes, and the entire margin miracle we discuss relies heavily on disciplined pricing, jacking up the margin to mask the volume drop. But you cannot rely on expanding margin forever if the actual physical volume of customers completely dries up.
Right, the math eventually catches up with you.
Eventually, mathematics takes over. A lower volume of customers multiplied by a higher margin per customer still equals fewer total dollars in the cash register. Furthermore, management's flat-out refusal to raise full-year guidance, despite a massive acquisition and a strong first half, screams that they see very dark economic clouds on the horizon for the back half of the year. They are battening down the hatches because they expect the consumer to break. The tension in your bear case is clear and valid. The micro-execution of the management team is stellar, but the macro environment they are forced to operate in is highly toxic.
So synthesize the bull case. What makes this a buy despite the macroeconomic hurricane?
The bull case for Arko is rooted in its aggressive evolution from a vulnerable, weather-dependent retailer into a fortified infrastructure powerhouse. First, they have proven themselves to be a cash-flowing machine with incredible pricing power.
That's very true.
They demonstrated in Q2 that even when physical foot traffic drops, they have the operational discipline to expand their margins and protect ultimate profitability. Second, their loyalty program is not a gimmick. The data proves it is sticky, it is successfully altering consumer behavior, and it is driving vital, high-margin prepared food sales.
The chicken sandwich strategy is actually working to offset the gas volume drop.
It really is. Third, the dealerization program is systematically stripping out the localized operational risk of running a retail store, converting highly volatile sales into predictable, recurring franchise fees.
Shifting the risk.
Yes. And finally, the USPP acquisition fundamentally changes the math of the entire corporation. adding 280 million gallons of capacity, plus acquiring physical pipeline terminals, makes their wholesale subsidiary a dominant force in the market. They are reaching a scale where they can dictate terms to suppliers rather than the other way around.
We have to take a clear stance based on the data. Does the sheer scale of the wholesale operations, the terminal acquisitions, and the dealerization strategy outweigh the very real, immediate macro retail risks for a long-term hold?
Based on the structural changes, I believe it does.
Really?
Yeah. If you are a short-term momentum trader, the volatility in the consumer environment over the next 6 months might give you heartburn. The stock will likely fluctuate with consumer sentiment data. But for a long-term hold, Arko is demonstrating precisely how a competent management team navigates a brutal downturn.
By fortifying.
Right. They aren't panicking and chasing unprofitable volume. They are structurally altering the business model from the ground up. By shifting daily retail risk to dealers and buying hard supply chain assets on the Buckeye pipeline, they are building a massive economic moat.
They're building a fortress.
Exactly. When the consumer eventually recovers, and they always do, Arko will have a significantly lower cost structure, massive wholesale pricing leverage, and a hyper-engaged loyalty base. They're transforming from a price taker into a price maker.
I find myself agreeing with that assessment. The sheer discipline required to not panic cut gas prices when physical volume drops shows a level of operational maturity that you desperately want in a long-term holding.
It's rare to see.
It is. They are willingly sacrificing top-line vanity metrics like total gallons sold for bottom-line cash flow sanity. It is not a flashy strategy, but it is exactly how a company builds compounding wealth over a decade.
And if we look even further down the road, looking past the next few quarters of consumer stress, this transcript brings up a massive unstated question. It wasn't explicitly mentioned on the call by analysts, but it's the natural conclusion of their current infrastructure trajectory.
I love a good forward-looking thought experiment. Where is this leading?
Think about the 10 to 15-year terminal value of this entire business as electric vehicle adoption accelerates.
Oh, wow. Okay.
We know the internal combustion engine is facing severe, long-term systemic headwinds. The sheer volume of gasoline pumped globally will eventually peak and decline.
So what is Arko actually building with these specific acquisitions? Is there aggressive expansion of high-margin food offerings, their deep dive into hyper-specific loyalty data, and their strategy of owning the real estate while franchising the operations actually a Trojan horse?
Explain the Trojan horse concept here.
Are they secretly transforming from a legacy fuel distributor into a hyper-local logistics and real estate empire, specifically designed to survive a post-gasoline world?
That is fascinating. Because if you step back and look at the assets, if you own the best corner real estate in thousands of towns, you have a captive loyalty audience conditioned to come in for prepared food, and you own a massive wholesale logistics network that can move physical goods efficiently, the gasoline eventually becomes irrelevant.
The gas is just the hook right now.
Exactly. They aren't just selling fuel today, they are building the physical nodes of a future local commerce network. When the pumps eventually switch from gasoline to electric fast chargers, the infrastructure they've built remains incredibly valuable.
Now that is a profound thought to chew on. As an investor, you have to ask yourself, are you just buying a legacy gas station company fighting a shrinking volume trend? Or are you buying the foundational real estate and data infrastructure of tomorrow's local economy at a massive discount?
It's the multi-million-dollar question.
It really is. A massive thank you to everyone for joining this deep dive. Keep questioning the numbers, keep exploring the mechanics behind the markets, and we will catch you on the next breakdown.